Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveney. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Welcome back, everybody. Today, I want to talk about a topic that I see a lot of people starting to get into, and I want to put some cautionary warnings out there. Today, we're going to talk about passive investing through private lending and talk about the silent risks that could drain your wealth. Because right now, real estate is very expensive. Interest rates are high. But we've seen a lot of individuals make that shift over to private lending. But just like any aspect of real estate, experience is so important that you want to make sure that you surround yourself with people who are smarter than you, who've been there, done that, so you can learn from them, but also give you some guidance and make sure you avoid some of the mistakes we're going to talk about today. So today I've got top 5 key points that we're going to talk about in private lending. Make sure that you are not putting yourself at additional risk. First, and probably the most important, is lien position. And what do we mean by lien position? Lien position is, if you think of a train, are you at the front of the train or the back of the train? Or front of the line, back of the line, wherever you want to evaluate if you're a concert, are you in the front row or the back row? Lien position is important because when you're in first position, you are in control. Meaning if the borrower defaults, you don't have to worry about junior liens or other money they've borrowed. Typically, you do have to worry about taxes and potentially other violations. But when you're in a second lien position, that's why I really want to focus on, is you are at significant risk because there's that first lien that you have to pay attention to, but also it's typically at a higher loan to value, which we'll talk about property valuations later. Let me share a story, somebody who was in a second lien position, and they thought they had significant equity because the borrower took out a first lien at about 50% LTV, and it was a private loan at 12%, and they gave a second position loan also at 12% for 25%, and the borrower put down 25%. So really rough numbers, $500,000 property after it was renovated. First position gave $250,000. They gave $125,000, and the borrower was putting an extra $125,000 in. But, thinking, I got plenty of equity. What can go wrong? Well, let me tell you a few things that went wrong in the situation. The borrower defaulted, and the interest rate on the first position loan went from 12% to 25%. So they went from essentially $2,500 a month payment, essentially double. And those fees just started accruing, and it was in a judicial foreclosure state that would take about a year to get that foreclosure through. So over that course of that time, essentially with fees and everything, about $75,000 worth of fees got tacked on in that first position. Meanwhile, your loan wasn't getting paid and got tacked on as well. So next thing you realize is you just, equity position wise, just lost 15% of your equity. You're thinking you're at 75, now you're at 90. And then after that, property wasn't valued worth they thought it was. Your second lien position in this instance pretty much got mostly wiped out. So it's really important to understand lien position and those risks. There's a type of lending going on right now, which is called gator lending, which is you're lending people money who can't even put down an earnest money deposit. They have zero money. So when you're lending, it's important to understand too, how are you going to get paid back? Because now you're in a subordinate lien position, but also this person has no money at all. If somebody has to borrow money for earnest money deposit, basically giving them a credit card debt. So if you want to charge 30%, go ahead, but just realize it's probably got a 40% default rate. The lien position I want to really touch upon, spend a few moments on, make sure people understand what position you are in and the ramifications that can occur. Next is I want to talk about borrower experience and understand how important experience is. And I'll share an example that we were recently looking at is we're updating some of our corporate documents for our fund. And I'm going through this, and attorneys are great, and attorneys will do what you tell them to. But as from experience and learned, you tweak things here and there. And I was telling my wife, and I said to her, man, this is like, I don't know, 7th, 8th, 9th time. I lost track of how many PPMs I've kind of updated, reviewed. I said, if I was doing this my first time, I would be completely lost. And all the things that I would leave out, I wouldn't even know. You don't know what you're missing. And it's the same thing in any business, especially private lending. And understanding that borrower experience is so critical, especially, if it's like a new construction project that you're lending on. Because does the borrower know how to get permits? Do they know how to deal with the county? What if there's proffers where they had to increase the water line size? Like, there's so many, what if they have to connect to a sewer system that they didn't, and there's fees involved? Like, do they know this? Do they not know this? There's so many things that experience comes into play. And experience is time as well, especially in real estate. The more experience you have, the better off you're managing time. One of the major components of private lending is, doing it as a 12-month loan, making sure you get paid in 12 months. But if you're working with somebody who doesn't have that experience, what happens if it goes longer? Are you planning for that money for something else, or, is it okay to float it? So it's important to understand. And when I talk borrower experience, it can come from different areas. A borrower could, for example, work for a residential developer as a superintendent, and they've built, $100 million worth of real estate. That's good experience. Could be a fix and flipper who's done 20 fix and flips. The important thing is understand also the experience component to, is it their first deal? And then how much money do they have as well? Because somebody who has no money and no experience is a recipe for disaster. It just is. It's rarely successful. And everybody's got to start somewhere. And that's why you always recommend people start with a significant amount of their own capital. How do you do your borrower due diligence? For us, we have them fill out, personal financial statement, list their experience, give us properties that they've done, real estate agents they've worked with, getting this information from them to make sure they're actually being upfront and honest. And then we skip trace them as well. Do they have a criminal history? Do they have liens from other properties that maybe they had some experience, but they didn't pay their vendors? Those are all important factors to understand as part of the borrower experience. We hope you're enjoying this episode of Creating Wealth Simplified. We wanted to take a moment and tell you more about our passive income fund at Seveney, which is open to both accredited and non-accredited investors. Our latest offering targets an 8% annual return distributed monthly, with the ability to potentially achieve a greater return through our bonus share program. If you'd like more information, reach out to us at invest@seveneyinvestments.com to learn more. Thank you. Next is something that is really interesting, which is the market conditions. And where the property located could be so significant. I'm recording this in early October 2024. We just had the strike with the union workers who work the docks. Iran just fired missiles at Israel. And a lot of stuff going on that could impact our economy, impact the markets. But one of the things that's already come into play is, and I'm seeing this in Florida, I'm seeing it in Oklahoma, I'm seeing it in Texas, is loans where a person bought the property, they fixed it up, their ARV after repair value is way off. When we looked at in Oklahoma, borrower bought a property cash, bought it cash for about $50,000, put $70,000 into it, which was a loan that they took out from a lender. They thought the property was worth $200,000. It's currently listed on the market for $100,000. The lender still has their equity in the property and they're probably still going to be okay. But the property was supposed to be sold 7 months ago. It's been sitting on the market for 9 months. And you speak to real estate agents, they're like, just the market. 2 that we've seen in Florida. First time fix and flipper. Built 2 homes, brand new construction, a few blocks from each other. Took out loans of paid cash for the property, $100,000 each, and took out $500,000 loans on each property. Started the properties in the 6s. And when you think about it, even starting in the 6s, after you pay real estate fees and stuff, probably looking to make 50, 100 grand, still good money. But now each one of those properties is listed in the low 5s. They're going to have to come out of pocket to pay off the loan because not only is it taking them longer, but they've had to get extensions on these properties. And each extension usually costs money. So the original $500,000 loans, they're up to like $550,000 owed on each one. And again, they're selling them for less than around $514, I think is what they're both listed for. And they've been like that for a month and they haven't sold. So it's probably going to go lower. But what's this person going to do? The lender has a personal guarantee, which is, we'll talk about structure and terms later on what to get on these documents. But now this person, could get judgments against them and other assets they have are up for risk because of, the market conditions. So very important to understand as a lender, and they could still go to foreclosure. The lender could foreclose, say they sell for $350,000 and this borrower has nothing else, to go after. That lender just lost significant money because of market conditions. Again, it goes back to lien position, that loan to value that we talked about, making sure there's plenty of fluff in these numbers, which rolls into number 4, that property valuation. And the need for accurate is the key word here, valuations. Some people would just use a BPO, which is a broker price opinion, which is really just getting some comps from a real estate broker. Some do an AVM, an automated valuation model, which is a computer, kind of like, ChatGPT before ChatGPT, spits out what the comps are in the area and gives you a number. Now, appraisals also aren't the most accurate. Just be fully upfront. We've had appraisals be way off. But you need some type of pricing and understanding, and you need to look at that yourself and review it. Is this realistic? And understand where, again, the market is headed, which we just talked about. Because that is key in understanding. Now, as a real estate investor, and going back to experience, a year ago, I've been telling people home prices can't continue to go up. In some of these markets, they have to soften, or they would, especially in coastal areas because of insurance and taxes. Governments were spending loads of money during COVID that they need to recoup, state taxes. And then insurance. The cost to build everything got so expensive. And insurance is based off of replacement value. So if a home that used to cost $250,000 to build now costs $500,000, insurance is now going to have to insure it to replace it for $500,000. What do you think would happen to the insurance? It would go up. Now, people listening, how many of your salaries gone up by 20, 30% over the last year or two? You've got a promotion maybe, but most companies are still giving 3%, 4% increases. If people's income isn't going up, but all the costs, other costs associated with things are, home prices just at some point become unaffordable, even if interest rates still come down. So a lot of these markets, especially where the average income is only $50,000, $60,000, you can't swing a house for $500,000. Some people can, but the majority can't. Eventually, it'll become that oversupply, and that value, unfortunately, would come down. So again, something really important to understand. Last is, and this is the one item on this list that I would say is something that you control 100%. Experience, you can still get it wrong because it could just be a bad deal. Conditions, nobody can really predict the future. You can kind of guess the headwinds, tailwinds, which impact the property valuation. Lien position, you can control where you want to be in first, but the loan structure and terms, completely up to you. And what do I mean by that? Do not go online and just pull documents from some website. Now, I'm a member of Bigger Pockets. They've got leases and other forms on there. Some of those documents, yeah, they're good. But if you're giving out a loan, the structure, the terms, and the process you go through, this is 100% in your control. You get an attorney to create the documents. For example, there's the note, the mortgage, the loan agreement, if it's an LLC, the LLC, a declaration that allows them to borrow money, a personal guarantee. Your attorney can create all these for you. And you can't complain that, it's a cost, because this cost is 100% passed on to the borrower on the HUD statement. So it's important to understand that you work with an attorney who can structure the proper documents. Because when I see people just going online and pulling a document, or just giving somebody money without even putting any documents in place, typically nothing good is going to happen from that. The other component with these loan structures and terms is going through a title company. I can't tell you how many times I've seen people just give somebody money, didn't go through title, and then the person disappears. And then it wasn't even a real name. They never got the person's identification. They never got an ID, nothing. They're just like, here you go, and just sign these docs. And the person's like, okay, signs the docs, sends the money, and then did not complete or fulfill. Go through a title company, have them pull title, get title insurance. Again, it's all passed through. Make sure the monies, that gets sent, go to a title company. So deed of trust or mortgage gets recorded, which is important. So you secure your lien position before they give the money. So this aspect of it, again, 100% in your control. So this one is out of the 5 that we talked about, is one that should never occur. You should always structure the terms to your desires, your likings. You never want to force a deal. So to wrap up today's episode, I really wanted to talk about these 5 key points. Again, your lien position, the borrower experience, the market conditions that impact the property valuation and the loan structure and term. Because as we see more people looking for passive investing, private lending, to me, much more passive than owning traditional real estate. But in order to do it, you want to make sure you do it right. Spend the time, take the ample opportunity to educate yourself and learn so you don't make these mistakes. Because just like in traditional real estate, you can suffer massive losses on private loans that could take you years or decades to recover. So I hope you enjoyed this episode of Creating Wealth Simplified podcast. As always, please feel free to reach out and leave us a review on Apple's iTunes or your favorite Apple iTunes or Spotify or your favorite listening station. If you want to know more about us and our current Regulation A+ offerings, please go to seveneyinvestments.com or hit us up at invest@seveneyinvestments.com. Take care. Thank y'all. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.